Hey friends, I'm back. I'm a serious dividend stock ETF investor these days, exchange traded funds. It's so funny, just 5 years ago, I was only about individual dividend stocks. And as you can see on the screen in front of you, I even filmed a video on the beautiful Ka'anapali Beach in Maui, Hawaii, about why I avoided ETFs and index funds, mutual funds, in favor of individual dividend paying stocks. Now, I don't want to forget my heritage because I love individual dividend stocks. There's a piece, it feels, of that American dream that I have fulfilled by actually owning shares of individual companies, and I own 36 of them. But recently, I started building a large position in SCHD, which is the Charles Schwab Dividend Equity ETF. I'm going to talk about that in the video today. That's an ETF that I own that is dividend focused. It pays a really high starting dividend yield. And I'm going to contrast that in the video today with DGRO, which is another popular ETF in the dividend, the income investing community. And so I'm going to compare those two today because I've received a ton of questions from the community. But before I even do that, I just want to start today why my story has changed so much. My story has really changed for two reasons. One, single company risk is higher than ever before. I will link to that in the pinned comment below, but I just did a video on Hawaiian Electric. It's a company I own that has tanked overnight. It's a regulated electric utility, and it has tanked overnight due to those terrible, tragic fires in Maui. Although the electric utility is claiming they are not responsible for those wildfires. Time will tell how that plays out. But right now, the stock has absolutely tanked. And so single company risk is one of the reasons I am so excited about ETFs these days, like SCHD. The other reason, the second reason I am so excited about ETFs is my life has become more complex than ever before. I keep getting more and more busy at work. Life in general gets more and more busy. I want to pursue other passions outside of investing. Actually, these days, we have been working out in our family a lot more, going to exercise, going running, being more active. I had gained some weight over the summertime with a lot of travel, a lot of fancy meals, if you will, not a lot of exercise. And now it is time to pursue that passion of exercise and fitness. And so that takes some time. It takes time away from investing. And so I also like ETFs because they simplify life. I guess the third reason I love ETFs these days, quite frankly, you're going to see in the video today with both DGRO and SCHD, is picking and choosing individual stocks. Quite frankly, it's going to be very difficult to beat these ETFs. They have performed so well over the years that why go through the process of picking individual stocks when it is so darn difficult to beat the ETFs? Now, don't get me wrong, I'm not abandoning my strategy. I continue to see my strategy as a blend of individual stocks and ETFs. And probably over long periods of time, I could see individual stocks probably representing about 70% of the portfolio, but ETFs getting up there around 30%. And I wouldn't mind having 30%, all of it in SCHD. But I want to compare the two in the video today. So let's start out. As you can see on the screen in front of you right now, the first screenshot that I want to show is just a broad comparison of SCHD and DGRO. SCHD is a Charles Schwab ETF. It's the US Dividend Equity ETF. DGRO is the iShares Core Dividend Growth ETF. Before I get into all the metrics I just showed, I want to give a very high-level overview of how these ETFs are different. Number one, SCHD is more focused. It has only 104 positions. DGRO has over 400 positions, so it's much more broadly diversified. SCHD, I would call it more of a value-oriented index. It follows the Dow Jones 100 dividend index. And what's so interesting about SCHD is it has that sweet spot yield, which is about, say, 3.5% starting yield, which is a little higher than my portfolio wide, but that's always been my sweet spot. It has a higher starting yield. It has a general, the holdings that it has have lower PEs. They're more value oriented. Whereas with DGRO, it is a lower starting yield, but it has companies that one would believe are probably on a quicker growth trajectory than SCHD. So it's more of a dividend growth-oriented ETF. And over very long periods of time, one may expect that DGRO would grow quicker than SCHD in terms of compound annual growth rate of dividends. But so far, actually, over the last 5 years at least, that has not been the case. But I would expect over many decades of time that probably would be the case. So basically, on the one side with SCHD, we've got a dividend ETF that offers value, offers dividend growth, and offers protected dividends. Basically, companies the index believes will continue to pay the dividends, whereas DGRO, it focuses really on companies that are growing the dividend quite quickly with broader diversification, lower yield, higher PE ratio on the fund overall. But as you can see on the screen in front of you, what's interesting about these two particular ETFs is they're both doing really well. We have had some volatile markets as of late. The markets have been up, the markets have been down, but SCHD, it's only 6.2% off the 52-week high. DGRO is doing even better. It's only 2.6% off the 52-week high. That is a lesson off the bat that ETFs can provide the investor with a minimum of volatility through diversification, which is something that I really respect and appreciate in this particular market right now, where I own individual stocks that have from time to time plummeted. Now, taking a step back, sometimes when a stock plummets like Hawaiian Electric, it is cause for concern, because I could see if they lose a lawsuit and they are found responsible for the fires, it could bankrupt the company or put the company in a terrible position. But sometimes when I have a company like RTX, or previously called Raytheon Technologies, and it corrects, it plummets, but I believe the fundamentals are still there, I actually look at that as a buying opportunity, and I like to cherry pick those particular stocks that go on deep discount. They go on discount because of opportunities at different moments in time. So it is still fun to be an individual stock investor as well, and to experience a little bit of that volatility, because it can provide opportunities. But in other cases, like Hawaiian Electric, I'm not so sure I really see an opportunity. Maybe there is, but I more just see downside. And I see the county of Maui just attacking this company, and that is a little too much, quite frankly, for me as an investor, and that's why I appreciate the diversification. But as you can see on the screen in front of you right now, with these two particular ETFs today, I want to highlight, as I already mentioned, SCHD is more value-oriented. And with something that's more value-oriented, the investor would expect a low-ish PE ratio. And that's what it is. It's a 13.87 PE. That's a really value-oriented PE. Whereas with DGRO, the PE is 16.94. So it's indicative of faster-growing companies, companies that have a higher valuation because of their perceived growth into the future. Now, as I had already mentioned, you can see on there dividend yield. It's a solid 3.5% for SCHD, which is just a little bit above my portfolio average. But DGRO, it's way down there at 2.36%. I would say the reason for that is they have some really fast dividend growers in there with lower payout ratios. Apple is one of their large holdings, for example. We'll go into that in a bit. But for the investor who needs immediate income now, like myself, I'm using my distributions from SCHD to help pay bills. I don't see that as much with DGRO. It's a lower starting yield. So DGRO is more for the persona of investors, probably who want to buy now, reinvest dividends, get a really good yield on cost in the future. Whereas SCHD, with a 3.5% starting yield, it can offer that dividend income right now that is meaningful enough to help pay bills. And so that's one of the reasons I like SCHD. The other reason I'll tell you, well, there's many reasons, but another one is I just feel like DGRO, it's kind of more of my classical investing philosophy. Oftentimes I'm in these dividend growth companies. Even though my portfolio yield more aligns with SCHD, I would say mentally and philosophically, I probably navigate more towards a DGRO type strategy. I like SCHD because it picks some stocks I would probably never choose myself. But when I look at DGRO and I look at the index, it's kind of very duplicative of the types of companies that I would naturally gravitate towards. And so I almost look at SCHD as a hedge against myself, a hedge against my own line of thought when it comes to dividend investing. And I like that. as you can see on the screen in front of you, I want to keep going. I would say here's where things get a little bit shocking. Over the last 5 years, SCHD has actually had a faster dividend growth rate than DGRO. It's been 13.9% on average. And the way that I came up with that is I summed up the last 4 payouts from each of these funds, and I compared to the equivalent 4 payouts from 5 years ago, and I'm seeing a faster dividend growth rate at SCHD. Now, just purely looking at that, I don't think that will continue into the future. I would expect over multi-decades into the future that DGRO probably would outpace SCHD in terms of dividend growth. But so far, at least over the last 5 years, that is not the case. As you can see on the screen in front of you right now, I would say the market capitalization of SCHD, it's about double that of DGRO, so it's a more popular ETF, although let's give DGRO some time to catch up because it's a newer ETF, I believe. Now, I also have some other metrics on there that I just kind of pulled from my own analysis or from the websites of these 2 ETFs. And so you can see the sponsor, Schwab iShares Index Dow Jones US Dividend 100 versus the Morningstar US Dividend Growth. The index goals for the Schwab ETF is quality and sustainability of dividends. And now there's some growth in there, certainly, but it really focuses on quality and sustainability, whereas DGRO, it really is focused on those companies that have a history of growing the dividends. Now, of course, there's some overlap, I'm sure, in philosophies of both indices. Now, the interesting thing, again, is since inception of both funds, and they were started at different times, the total returns for SCHD have surpassed DGRO based on the data I was able to pull from their websites. Schwab is up at about 13.27%, whereas DGRO or iShares is at 10.89. Now, over the last 5 years, which I'd say is more comparable because we're looking at the same time period for both funds, Schwab just slightly outpaces iShares. Schwab is at 11.67% total returns on average per year versus 11.13 total returns per year with DGRO iShares. They are very close over the last 5 years. And you can see that they are both very, very solid ETFs. But I am just surprised how well Schwab, SCHD, has done over the last 5 years. And it's indicative perhaps of how much investors have gravitated towards value. It's also indicative of how well the index, the fundamental strategy, the algorithmic strategy of that Dow Jones 100 dividend ETF index works. It's amazing. The bigger meta level point, though, quite frankly, is 11% annualized per year with reasonably conservative dividend-oriented ETFs over the last 5 years is simply phenomenal, 11% per year on average. And the way I look at that is whether I went with Schwab or iShares, I couldn't have gone wrong, and I would be hard-pressed, quite frankly, to beat those numbers in my own portfolio. And so that's another reason, pointing back to reason 3 these days, I love ETFs, and I've kind of come full circle in my own strategy and have evolved as an investor to incorporate ETFs into my strategy because I am impressed with those results, and it is hard to beat those results, and it takes a lot of time and effort to beat those results where I could be spending my time doing other things. And so let's keep going. As you can see on the screen, the next thing I want to share is the holdings. Schwab is way more focused with 104, whereas DGRO is 428. I more align myself with something more focused, so I kind of like Schwab's strategy versus the Morningstar index strategy. Just having fewer holdings, 428 holdings feels kind of heavy to me. Top 10 concentrated or concentration, Schwab is way more concentrated. The top 10 comprise 40+% of the ETF, whereas 26% is concentrated in the top 10 of DGRO. Next, I wanted to look at the overlap that my personal stock portfolio has with these funds. And as you can see on the screen in front of you, what I found was that with my portfolio, which has 36 positions, only 9 of them were found in SCHD, but 17 of them were found in DGRO. So I had a lot more overlap with DGRO, but that would be expected with an ETF that just has more holdings overall. It has over 400. Now, when I weighted the overlap and I just looked at the percentage allocation in Schwab and the percentage allocation in DGRO, even though I had fewer holding overlap with Schwab by percentage, because those holdings that do overlap comprise a huge percent of the Schwab ETF, I had a bigger percentage overlap. But both of those were well below 30%. Schwab came in at 27.7. DGRO came in at 24.02. And what these numbers tell me is that both of these ETFs could add a lot of value to my portfolio because there's not a ton of overlap. I feel by buying the ETF, I'm not just rebuying the individual stocks I already own. I'm buying something net new, which is so darn important. Now, in terms of expense ratios, they're both very efficient. Schwab comes in at 0.06% expenses. DGRO comes in at 0.08. And so I'd love to know what you think about these ETFs. Do you invest in dividend ETFs? Do you like dividend ETFs? Which ones are your favorites? Do you like these two? Put in the comments below. I always read all of the comments. I don't always respond to all of them, but I try to respond to as many as possible. What I want to do next is I want to share some of the top holdings from these particular funds. As you can see on the screen in front of you right now, what I want to start with are the top holdings of Schwab. And you can see it's Amgen coming in at a really high 4.41%. We've got Cisco, we've got Broadcom. I highlight the ones that I already own. So you can see in the top 10 of SCHD, I own 5 of them. AbbVie, Home Depot, Coca-Cola, PepsiCo, Chevron, and so I have a lot of overlap. But on the right-hand side of the screen, you can also see in the top 10 of DGRO, I have a lot of overlap. I actually overlap on 6 of them, which are J&J, AbbVie, Chevron, Procter & Gamble, Home Depot, and Pfizer. And so I have overlap when it comes to both, but quite frankly, that overlap is a little bit lower even than I would have expected. It's well lower than 30%. And so these days, what am I doing in my personal situation? Just speaking to my personal journey, I am buying SCHD pretty much weekly, and my patrons already know this. I'll link in the pinned comment below so you can learn more about my Patreon. Over on Corner Patreon, I have Zoom meetups from time to time. It's really fun, and so check that out. And on Corner Patreon, I share my complete dividend stock portfolio, percentage allocation to each position as well. And all over on Patreon, a lot of fun updates. But my patrons already know I've been buying this SCHD pretty regularly. Will I be buying DGRO? Probably not. If I were a younger investor who had more years ahead before I was tapping into cash flow, and I knew now what I knew, I knew back then what I knew now, and I knew where the world was headed with single company risk, maybe I would add some DGRO to my portfolio as well. But for me in my 40s right now, using dividends right now, looking at all the metrics I shared today, especially the starting yield and the really high performance of both funds, the dividend growth rates on both funds, I'm an SCHD investor. But put in the comments below if you're seeing something different with DGRO. Do you like DGRO? Do you like it better than SCHD? Share with the community below. It's always such a fun and lively discussion. I love you all. I really appreciate your support. Please go ahead and click the like button if you enjoyed the video today. I've been really busy at work, so I do apologize that this video took a while to get out. I'm hoping to get back more on a normal schedule. Please don't forget to subscribe as well, because like I said, I do plan to get back on a normal video posting schedule. Before I go in terms of a full disclosure, I own the positions discussed today. I am long Hawaiian Electric, ticker HE. I'm long Raytheon Technologies, ticker RTX. I am also long AbbVie, ticker ABBV, Home Depot, HD, Coca-Cola, ticker KO. I'm long PepsiCo, PEP, Chevron, CVX. I'm long Johnson & Johnson, ticker J&J. I'm long Procter & Gamble, ticker PG. I am also long Pfizer, ticker PFE. I own those stocks in my personal dividend stock portfolio. Also, it's really important to share my disclaimer. I am not a licensed investment advisor. Today's video is not investment advice. I'm just sharing my journey here on YouTube for fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult your licensed investment advisor first. I'm just sharing my journey for fun and entertainment. It's possible to lose money in the stock market, and I'm just sharing my journey. I have additional disclosures and disclaimers in the video description below. I love you all. I'll see you in the comments below, and I'll see you in the next dividend stock investing video.